Welcome back to Mark Carney's book club. Today we are starting the second to last chapter of this book, and it's chapter 15 called Investing for Values. This chapter starts with a section called The Rise and Rise of ESG. It is now imperative that mandatory reporting of climate-related financial risks is instituted so capitalism can help solve the climate crisis. In parallel, the spread of impact investing could prove decisive in achieving the Sustainable Development Goals. This is building upon the discussion from chapter 14. A company's actions influence and determine a wide range of sustainability outcomes, commonly referred to as ESG, which is environmental, social, and governance. The rapid rise of ESG measurement and investing is the most promising contribution to the creation of stakeholder value. ESG investing grew out of philosophies such as socially responsible investing that developed in the 1960s. The early SRI models used value judgments and negative screening to identify which companies to avoid, such as those that were involved in tobacco or active in apartheid-era South Africa. The considerations have broadened since then, and while there is no agreed list of ESG factors, the types of issues generally included are set out below. So under the environmental impacts, they look at climate change and greenhouse gas emissions, air and water pollution, biodiversity, deforestation, energy efficiency, waste management, and water scarcity. Under the S, or social contributions, they look at customer satisfaction, data protection and privacy, gender and diversity, employee engagement, community relations, human rights, and labor standards. And then under the governance and management piece, they look at board composition, audit committee structure, bribery and corruption, executive compensation, lobbying, political contributions, and whistleblower schemes. From a climate perspective, the distinction is between divesting all energy companies and selecting those that have net zero targets and credible strategies to achieve them. In other words, avoiding those which are part of the problem and supporting those which are finding solutions. As we shall see, as society places greater value on sustainability, this form of capital allocation has the potential to create a new asset class that could be critical to driving the whole economy transition needed to solve climate change. He's now going to explain to us how ESG can guide stakeholder value creation. ESG assets seek to do well by doing good. Impact investing seeks to support positive social or environmental benefits alongside financial returns. At one end of the impact spectrum, finance-first strategies seek to generate competitive financial returns, while at the other end, impact-first strategies accept below-market returns. Finally, values-based investing aligns portfolios with the moral values or beliefs of the individual or organization. These are often, but not always, philanthropic, investing in the expectation of partial, if not complete, loss of capital to advance broader social goals. This chapter will concentrate on the finance-first impact investing strategies, and these approaches use the premise that companies that create stakeholder value will create greater shareholder value. When he's talking about stakeholders here, stakeholder being different than shareholder, obviously, but stakeholder is just anyone who has an interest in what the business is doing. General society and social good being a stakeholder as well, because they are affected by the externalities of what the corporation does. He's saying that those that taken into consideration the other stakeholders outside of the organization will create greater shareholder value. That superior performance could be for a variety of reasons. These companies could be better managed in general, and good ESG performance serves simply as a proxy for that superior management. In addition, companies that balance the interests of all stakeholders could be more likely to create greater long-term value for all parties, shareholders included. Most fundamentally, the broad alignment of shareholder value and stakeholder value could occur when the purpose and the competitive advantage of a company both depend on the achievement of a specific social or environmental value. This is termed shared value. In a phrase often attributed to Albert Einstein, not everything that counts can be counted, and not everything that can be counted counts. As we shall see, there is a proliferation of methods to expand the universe of what is counted to determine whether society believes it counts. Next, he's going to talk about performance. So there is considerable evidence that sustainable investing strategies outperform traditional ones. Morningstar found that, on average, over 3/4 of sustainable funds available to investors 10 years ago have survived, compared with less than half, 46%, of traditional funds. He thinks that this outperformance may be due to the ESG factors reported, finding new information about company performance which isn't elsewhere reported. There is also evidence that the financial valuations of strong ESG performers increase as the values of society move in their direction. In theory, the more that society values the transition to net zero, the more valuable companies that are a part of the solution will be because of greater demand for their products, as well as because of developments in regulation and carbon pricing that support society's objectives. Next, he's going to talk about fiduciary duty, and fiduciaries are those who have been given a special level of trust to look after the interests of another party, as well as given the power to act on their behalf. Fiduciaries are required to act not out of personal interest, but in the interest of the beneficiary and comply with their duties in this regard as stipulated by law. Corporate directors, for instance, as fiduciaries of the corporation and, as discussed in the previous chapter, must act in its best interest, whether that is framed as maximizing shareholder value or balancing a range of stakeholder interests. Institutional investors, from pension funds to unit trusts, owe a fiduciary duty to those whose money they manage. Thus, with investing, we return to the same dilemma posed within corporate law. Is the fiduciary duty solely about generating profit for the beneficiary, or is there something more? And this is interesting because I've talked about fiduciary duty in regards to Mark Carney when people criticize his use of tax avoidance schemes for the companies he worked for. But when he was working for those corporations, he had a fiduciary duty to do what was in their best interest. And tax avoidance is legal. And he wouldn't have been doing his fiduciary duty if he hadn't been taking advantage of what those loopholes are. And besides, if the Conservatives were so concerned about Brookfield and the tax avoidance that may have taken place, they wouldn't all be invested in Brookfield, right? Recent polling and evidence in consumer trends from larger asset managers reveal that owners of capital do care about more than profit and would like investment decisions to be made with regard to ESG considerations. In the area of pensions, we have learned, unsurprisingly, that UK cancer researchers do not want their retirement savings financing tobacco companies, nor do Ontario teachers want theirs financing immigration detention centers in the United States. This is regardless of how profitable promoting a cancer-causing activity or locking up children may be. It says that a fiduciary duty, which adequately accounts for the interests of beneficiaries, must move beyond financial considerations and incorporate ESG factors when making investment decisions. And we're going to end part 1 there. In part 2, we will continue on this discussion about fiduciary duty. So stay tuned and let me know what you think so far.